Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, and Sandip Bhagat, Chief Investment Officer at Whittier Trust. We're here to discuss why the current environment could be supportive for economic and earnings growth. It is great to have all of you with us. Welcome back to the show, Sandip. Always a pleasure to have you on. And the question is, how much longer can the relative calm stay in the market?
The first half of the year was quite a roller coaster, right? You normally talk about the calm before the storm. This time, everything that created that storm of volatility, and I can think of trade and tariffs. We had geopolitical risks with Israel and Iran, and then throw into the mix the deficit, the tax legislation that added to the deficit, and there was that cocktail of concerns, which now seem to be dissipating. Trade and tariffs have receded. Geopolitical risks, we have long maintained that they make for great drama and theater, but they rarely have a lasting impact, let alone meaningful impact. And so now we're looking at fundamentals, and what do we see? We see that second quarter GDP, the first estimate came out at 3%. Third quarter real-time GDP estimates are running at 2.3%. And the earnings season was simply spectacular. What was expected to be a meager 5% growth year over year is now clocking in at about 12%. So those fundamentals, really, earnings drive prices. So those seem to be intact. And looking ahead, all of those catalysts that created the storm, I think, have dissipated. So this might be a kind of boring, grinding higher type of market. Well,
one catalyst, certainly, Michael, in your note that just came out recently, kind of blew my mind. Tech and AI investment, increasingly important part of the U.S. economy. It's nearly 6% of GDP.
Yeah, it's if you take kind of a holistic view of tech and AI, look at software, if you look at equipment investment, if you look at structures investment, it's up to 6% of GDP. In 2010, it was 2.5%. So today's dollars we're talking about, it's currently $1.8 trillion on an annualized basis. So really a huge amount of money going into the economy there. And kind of the point of the note was, even if we haven't seen a lot of profits from AI investment, the U.S. economy is still benefiting with all that CapEx counting towards GDP. So if you look at the contribution to GDP growth, and the headline numbers that you mentioned are a little distorted in the first half of the year just because of all the import front loading and then a payback in Q2. But if you look at the contribution to GDP and you average it over the first half, a full percentage point came from that tech and AI investment. And so if you were to strip that out, first half GDP was just 0.2%. So it's really actually a material driver of the economy right now, and having that kind of secular uptrend in AI investment is going to be a key support of the economy when we've had consumer pulling back a little bit, when we've got DOGE cuts, of course, reducing federal spending, so that's going to be a drag on GDP by design. So it's important to have something offsetting those.
Yeah, I think it's interesting, Max, but Michael also cited a report that MIT had released on Monday that 95% of companies are getting zero return from their AI investment so far, right? There is a learning gap, and companies are learning how to best integrate these tools. I think perhaps companies should get a passes. It takes time. You just don't put a tool in and expect, 100% return the next day.
Yeah, we're definitely early still. I know everybody keeps saying that. You said in 2000, this is going to be a very long-term trend. It's not just a short-term, quarter-by-quarter thing to evaluate. I think the long-term trend is still bullish. It is still going to be help growth, help productivity. It's that question of, like you said, return on investment. Right now, you're probably not going to see it, but at what point do you start expecting to see it? That's really the question. And kind of who are going to be the winners and losers. We've seen a lot of the winners. That mega cap space has been really, like you're talking about, earnings season is great. They're really driving a lot of that. Now, if that slows up, obviously, we've seen some headlines. There's a massive, war for AI talent, but then there's some cutting of divisions. So I think there's still going to be some shaking out to do of where the funding is going to continue. I don't think the build out is going to slow down, but the only concern I think is you're starting to hear more about the large language models. They're commoditized, and the small models are going to be the one. The agentic is really what's going to start driving productivity. Internal stuff is going to be driving it. So if that pulls back on some of the CapEx spending or investment into these products, that's the only kind of concern I have. But again, in the long term, maybe short term, it's a trading opportunity, might move lower a bit. Long term, this train is not stopping. It's the new internet. That train is not going to be stopped. It's how quickly are we going to get there, and what are investors looking for? Because obviously, seeing multiples start to expand. We see big price multiples for some stocks, but they continue to grow into it. Everybody had those questions about NVIDIA at first. They're still growing into it. So we're starting to see that they're kind of earning their way into those multiples. If investors start to question that, and IPO market starting to pick up, maybe there's other avenues to invest additional capital, take some profits out like we've seen in the last few days. And look, it's the doldrums of August, so maybe it's not as big of a deal. We're going to get some choppiness, but if that rotation happens, kind of where does it go into?
Yeah, I would agree with Max. I mean, this is a tailwind for the next few decades, not just in the tech space, but
absolutely. Look, this is not incremental innovation. You have innovation that sometimes becomes a revolution, and history has shown that revolutions unfold over several decades. Think any major turning point, the steam engine, the automobile, its effect is lasting. And this is particularly exciting. And look, there has to be a show me story here. You cannot keep skating by spending money. We have built the infrastructure. It's time to monetize it with applications that create enterprise-wide solutions that have economic value. But when that begins to happen, you will unleash productivity growth. And productivity growth is so powerful because not only will it add to economic growth, it will also be disinflationary.
Yep.
So what is the value of a financial asset? You have a series of cash flows that you discount with some interest rate. This is going to affect growth and cash flows and also lower inflation and interest rates. So this is a really promising development, setting up almost a golden age for investing in risk assets and growth assets.
I wonder if it's investor behavior where we've become so conditioned to immediate results and wanting to see that ROI and buying the dip and being the FOMO mentality, I feel like is creating some short-sightism, if you will, and not recognizing that this doesn't happen overnight, and it's more expansive. To your point earlier, it's like the assembly line, with the Model T, with the internet, with this. It's not going to be,
overnight.
A checkmark trade.
Right. Yeah, and I don't know. This almost becomes philosophical and somewhat spiritual.
Right.
Growing up in the East, kind of has taught me lessons to be patient and not seek that instant gratification and to think long term. And in a way, the short-termism and the need to see results and rewards immediately, right here, right now, actually creates such opportunities for us. So I'm at a wealth management firm that focuses on enhancing intergenerational wealth. Long-term is not the rest of one's lifetime. It's 2, 3, 4 generations stacked up one after the other.
Yeah.
So over that 40, 50-year horizon, many times we get great entry points from everybody's obsession with the short-termism. But it really is almost sad that they lose sight of the forest for the trees.
Yeah, I think, Max, I also think there's a lot of lines that are being blurred as well. Because you have social media influence, you have traditional media influence, you have day trading, swing trading, short term, longer term. So there's something in there for everyone.
There's a lot of noise. There's a ton of noise.
Yeah.
Everybody looks at markets differently. Whether it's short term for a day trade, is it a 5-minute trade, is it an hour, is it a day, a week, 6 months? Everybody has a different kind of time horizon. I also think we get a little bit caught up in, there's definitely the FOMO. The AI hype cycle. We saw this with blockchain, what was it, 7 years ago, where you start changing your name to, I'm a blockchain company now. There's going to be winners and losers. There's going to have plenty of big-time generational winners. There's also going to be losers. Not everybody is going to succeed. The overall product, I think, will be beneficial for the entire world in the future, but not everybody is going to participate that is involved in the space right now. So that's where I think maybe you'll see the froth, as you see some of these blow-off tops where everything starts to move again together. There's going to be winners and losers, but again, like you said, long-term, the opportunity is there. It's what is your time horizon? What are you looking for? And again, are you looking for immediate gratification, immediate return on invested capital as an institution? You might not be as happy, but if you're seeing the entire forest and long term, okay, this will come back to us in spades. It just might not be in 3 months. We're kind of in that quarter by quarter basis instead of looking at it, hey, what are we doing over the year, 5, 10-year progress that we're looking for versus this quarter, this is what we invested, but we didn't see a return yet. Can you get through that versus, hey, let's just manage our way through. We see what's coming at the end of the tunnel.
Just a quick word. There is a bit of a feeding frenzy out there. And so it does behoove us to be somewhat selective. There will be big winners, but there will be big losers too, right? So look for companies that have proprietary data that no one has with which they can unlock value for their customers. And so avoid the fashions and the fads, and that's easier said than done. But my main note of caution for the viewers is to be careful and be selective.
Yeah, and Michael, you pointed out in your note as well with the 4 AI hyperscalers, Amazon, Meta, Microsoft, and Google. CapEx is 150 in 2023. It's projected to be 400 billion next year. Clearly, they see some long-termism in this as well.
Right, and of course, it's just a capital-intensive business to be in.
Right.
So you have to spend money to make money, I suppose, right? But yeah, it's a pretty staggering increase in CapEx that we've seen in just a 3-year period, where we're going to be tripling what they were doing a few years ago by next year.
Yeah. Any broadening out elsewhere?
Started to see, I mean, I've kind of been looking at software. It's been under a bit of pressure. I think tech is still going to maintain its focus. But let's see now if some of those come off. Do we start to see a healthier rotation? Even yesterday, what was it, about 60%, 70% of the S&P 500 was positive, even though we had the pullback. I think you're starting to see it broaden out. I also think the IPO market is really starting to open up. You're seeing investors looking for different avenues, where to put their money into the work. We haven't had that in a while, and I think there is an appetite for more risk outside of just the hyperscalers. And we're starting to see that again in the IPO market, really starting to broaden out. We're seeing more deals come to the table. And also, I think digital asset space is also, that's still tech, but that's really seems to catch real momentum at this point.
Especially as investors are starting to demand more access to alternative investments. That falls under that bucket as well. You made an interesting point, though, that fears of stagflation, they're just not materializing at this point either.
Yeah. So let's talk about inflation, right? So the fear was that tariffs would flow through and create a substantial increase in inflation. We didn't see it in the last CPI print, and I would just alert folks that all of it need not be absorbed or passed through to the US consumer. Just imagine a global supply chain. I can think of at least 4 or 5 nodes in this process. You have the foreign manufacturer, the foreign exporter, the domestic importer, the domestic retailer, from where the US consumer may buy his or her goods. That cost can be absorbed at any point along the way. 2 of the first nodes exist outside the US, so that cost can be absorbed before that product hits the US shores. And if the other fear was that if not the US consumer, the US corporation might absorb the burden of these tariffs and tolerate lower margins, but spare the consumer of higher inflation. Well, this earnings season, which is almost done, it's 90+% over. I'll give you one set of numbers. Net margin exactly a year ago, so think second quarter 2024, net margins were 12.1%. This second quarter 2025, net margins 12.8%. So margins are actually higher. They're not getting dented or eroded or destroyed by tariffs. And now the skeptic will say, wait a minute, the worst of tariffs is yet to come. You built up the inventory in anticipation of the tariffs, and so you haven't felt it. I just have a feeling that it will not nearly be as bad as people have feared all along. My worst case scenario is tariffs overall will dent US GDP by about 0.5% in the worst case. The impact on inflation will similarly be about 0.5%, but will not last until this time next year. This time next year, CPI inflation of both the headline and the core variety will be closer to 2.5.
Yeah, I also think, Michael, consumers were, it was pretty shocking, some of the prices that we saw. If you look at areas in the economy, whether it's insurance, it's taxes, it's other areas within GDP, cost of food, cost of cars, I almost think corporates can't pass that down. It's almost like a calm story that you don't want to have to deal with.
Yeah, well, I'm a little bit less optimistic than
Yeah.
you are. I suspect that there is still more to tell in this story, and that it's hard to make pricing decisions when so much is changing, like we saw in April, May, June. So I think we're still in a little bit of a wait and see mode. Not to say that your outcome isn't feasible, but I'm just not ready to hitch my wagon to that just quite yet. But I think it is true that you do read anecdotal reports where companies are saying, and we're looking at 5 years, 6 years of above trend or above target inflation, and people are sick of these price increases, and they're just not going to take it anymore.
Yeah.
So if that's possible economy-wide, I'm not so sure.
Yeah.
But I think really, at all those nodes, everyone wants to keep passing the buck, right? And the last stop is the consumer.
Yeah, well, I think
Not me.
right. But Max, I think what's interesting is not necessarily that one big data point that we get with consumer sentiment, but how they are spending money and where they are spending money with more real-time data is what the tell is here.
Yeah, I mean, it's still trudging along. Like, it's not a big negative. I also think with the inflation print, I don't see it as a long-term continuous where it's a supply chain issue like we saw a few years ago, where it just kept heating up because we had these bottlenecks and we just couldn't get the supply there. There was a massive supply and demand imbalance, and that's what's really driving it. If it's a short-term, one-time shock, so be it. I just don't see it continuing on. I think services are still going to continue on. We're starting to see it. We always talk about the housing market being unlocked if rates start to come down. I think the jobs number is, in my opinion, more concerning than the recent CPI print in PCE. That seems to be, the Fed minutes just came out. I'm not sure how much they're focusing on it right now, but I don't see the inflationary shock. I think we're just, I don't want to say beaten dog, but after the last few years and the inflationary shock we had, it's kind of programmed into us. Whereas if you had said this 3 years ago, 4 years ago, before we started to really see that ramp, we're running at 2.5, 2.6, 2.7. That's not that big of an impact where it's this big psychological thing, inflation. We were at 9% 2 years ago. So
Yeah.
I think it's more of a short-term, one-time shock where it's not going to continue to go on because we don't have those imbalances and supply bottlenecks. They're still coming through. It's just that the tariff being added on.
Michael, I appreciate that. It's so easy to advance a thesis, a hypothesis, or a plausible forecast. But who knows, right? Only time will tell. But there is one data point that I look at closely, which gets priced in the marketplace by experts every single day. And that's the five-year forward inflation expectation. So that takes it out to that time horizon that you were talking, where companies are worried about that 5, 6, 7 year period where inflation.
Oh, I'm sorry, I meant to say the past 5 years. I do generally agree that inflation is going to be higher in the next. I think it is a temporary kind of thing. I just think that 0.5% is maybe on the low end of what's realistic. So I don't totally disagree. I think it's just the magnitude where we're a little bit different.
Yeah, but I think Max's point ties into what you're saying as well. Even though COVID started 5.5 years ago, some of those effects did take time to move through the system. I mean, we had those bottlenecks, and then you get flooded with the products and services and so forth. So it's still, even though it was 5.5 years ago, we're still learning what the outcomes were.
Yeah. So that response was so draconian from an economic point of view. Look, it was a great tragedy and lives were lost, so we can only be sympathetic on the topic and really nothing else. But that global lockdown, every sector, every industry all across the world, was a shock that the economic world had never experienced. And we froze and calcified the supply chains to such an extent that to thaw them out, it just took a very long time. I dare say if this happens again in the future, that will not be one of the policy responses. They will do everything to save human lives, but this was quite an extreme example. Just to complete that thought again for the viewers to kind of ponder or reflect on it, that five-year forward inflation expectation has barely budged has remained stuck at 2.5%, which is really low.
Well, appreciate everyone's insight. Great conversation as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.